Thanks for joining today. I'm pleased to introduce Kabi Thaya, partner and institutional strategist at Munro Partners, based out of Australia. I wanted to take the time to have a sit down with Kabi today and just do a intro about the strategy, what they do in Munro, themes that they're seeing in the overall market, and some of the tactics that they apply when managing clients' money. So Kabi, thanks for joining us today.
My pleasure.
I'd love to just get a quick introduction on yourself, your background, and then I'd love to hear a little bit about Munro and their investment philosophy and their process and how they operate from a day-to-day.
Yeah, absolutely, and thank you for having me, Eric. This is this is a new format certainly for us to be distributing some of our content through. So we do appreciate the opportunity. Look, my name is Kabi Thaya. I am the partner, as you said, partner and institutional strategist here at Munro. Munro is a global growth equity investment manager based out of Melbourne, Australia. Now, if you haven't figured it out already, I am not Australian. So my job is obviously to be here in Canada and sort of be the North American conduit, or the mouthpiece, if you will, for the investment team over in Melbourne, Australia, to be able to have these types of conversations with people like yourselves and obviously with your end clients, to make sure that we're being as transparent and open about the way that we think over at Munro. And to answer the second part of your question, what we do at Munro, as I said earlier, is we invest in what we call structural growth. And so really what that means is we're investing in companies that are able to grow their earnings in a consistent manner on the back of some sort of secular shift or structural trend that's occurring in the world. And this is we're using words here that may not be as familiar to an investors, but really all we're doing is investing in companies that are changing the way that you and I and everyone else are interacting with the world itself. So think about trends way back in the day that started, such as e-commerce, or even before that, think about fast food with McDonald's, for example, right? So all of these businesses came around, and again, a handful of winners came around to really show how well they could help us facilitate that trend, or to help us to ultimately benefit from that structural shift that was happening in the world. And so what we do at Munro is we try to invest in companies that are growing, as I said, growing their earnings, not just for a year or for 2 years, but can do so in a structural manner, basically in a sustained manner. And we have a formalized process to figure this out. And the reason we do that, Eric, is simple. It's earnings growth always drives stock prices, right? If you look at any publicly traded company in the world, and therefore any market in the world, any benchmark or index in the world, think about the S&P 500, the NASDAQ, et cetera, et cetera. If you look at the underlying companies and the earnings that are being driven by these companies, the share price will follow. So if I put a chart of any index or any publicly traded company up with its earnings growth, and then of course its share price, they'd be very tightly correlated over a long period of time. There are obviously short-term periods where that dislocation happens, which can provide opportunities, but over a medium and long-term view, any publicly traded company will ultimately have its share price follow its earnings. Now, why do we only look at structurally growing companies as opposed to looking at any company in the world that can offer earnings growth? Is simply because, and again, a nice way to sort of put context to this is to reference a study that we always like to share with clients. It was a study that ultimately was done. It was published in the Journal of Financial Economics back in 2017, and ultimately an economist named Hendrik Bessembinder, he wanted to actually see if it was worth investing in the stock market in general. And specifically, he wanted to understand if it was worth investing in stocks over investing in treasury bills or other forms of risk-free investments that would compound a humble, maybe a low single-digit return over a long period of time. And is it worth even taking risks to try to generate returns beyond that? Now, I'll give you the Coles notes on the findings here, which sort of tie into our philosophy. The answer was yes. He did figure out that there were returns to be made over and above just the treasury bill return that was out there. But what he did find out was that it was only a handful of companies that drove that return. So we're talking about 90 years worth of data, and specifically about 26,000 data points of individually listed companies over that period. And what he figured out, believe it or not, was that only 4%, or roughly 1,000 companies of that total, of that total data set, if you will, were responsible for driving all of the wealth that was created in the US stock market over and above just investing in regular treasury bills or as I said, risk-free assets. And so what we did is we looked at the top 50 of those companies, right? So now we're talking about an even smaller subset, about 0.2% of statistical observations. And they actually, funny enough, so we're talking about 50 companies that represented about 40% of all of the wealth that was generated in the US stock market, which is pretty incredible to think about. And so basically, that's what we tell investors is that there's a handful of winners out there. Most companies are going to lose you money, but have a process to cut those losers and run your winners in bigger sizes. And that's all we do here in the form of very concentrated portfolios. And specifically, again, going back to those 50 companies, all of them, or the majority of them, were again beneficiaries of some structural shift. You know, social media with Facebook, digital payments with MasterCard and Visa. Think about companies that did like McDonald's and fast food, or Amazon with the e-commerce trend. So we can keep going down, but ultimately, what we try to do is figure out what the biggest problems are in the world that require large amounts of money to try to fix them, and then find the companies that are going to be recipients of that money that can turn that money into revenue and earnings growth. And then our job is to invest in those companies on behalf of clients. So long-winded answer, but hopefully that gives you some context into what we do and why we do it.
No, that's a fantastic summary of the philosophy and the process that you guys are using through the day to day. And speaking of day to day, given the current market reactions with the geopolitical situation and the macro data, a lot of noise out there. I see a lot of our clients are really paying attention to the news headlines. So my question is for you guys is how do you really differentiate between what's noise and what's really important and what requires a decision to be made for you guys to make an adjustment within the portfolio?
Yeah, it's a good question. I think from time to time, we really, in markets in general, we go through these periods of being so hypersensitive to every little data point, right? And again, going back to the fact that over long periods of time, it is in fact earnings growth that drives the stock market. Well, I think if you looked at, and sometimes it's helpful to show visuals here, but if you looked at the earnings profile of a MasterCard or any other structural growth company that we know today, a Microsoft and NVIDIA, so on and so forth, these structural companies can grow their earnings through the macro cycle, right? And that's important to remember over a long period of time. And over time, the share price will do the same thing. So I guess to say it differently, in a time like, as you said, we're in today, when, you know, anytime President Trump says one thing 1 hour or says another thing the other hour, or there's a jobs data report, or there's an unemployment number, or there's an inflation reading, CPI, PPI, all of these little things that I'm not trying to discount the importance of every single one, but I do think that if you're caught trying to trade your portfolio or trade your overall exposure to equity markets on every single data point, you'll end up just spinning circles and not adding much value, because these things can imply different takeaways on an hourly basis or at least on a weekly basis. And ultimately, I think it's important to step back and understand which one of these data points or which of these data points taken together are actually signaling a trend that will ultimately impact, for us as fundamental investors, impact the actual earnings, the bottom line of the companies that you're investing in. So, you know, for example, if you're looking at a company's earnings result and they're implying to you that their earnings growth is slowing, or for example, maybe a more relevant example today, when you think about the artificial intelligence trade or the artificial intelligence boom that's happening, which we're obviously big proponents of, when one of these big cloud computing companies like an Amazon or a Microsoft, if they were to come out and say, well, actually, maybe we don't spend as much money on AI going forward, and they bring what's called their CapEx numbers down, which is not what's happening, to be clear. But if they were to do that, then okay, that's something material. We need to take that away. That's clearly going to impact, because that money turns into revenue for companies like NVIDIA and many others through the portfolio. So that's a situation where we would take that to the table at our weekly risk meeting and debate whether or not we need to cut the exposure to certain themes, or maybe bring our entire equity exposure even lower than where it is today. As you know, Eric, we do run a long short strategy for clients that where we can not only just raise some cash temporarily, but we can go to 100%, up to 100% cash if we wanted to. So there's a variety of ways we can do that. But first and foremost, we need to understand, is there a real justification for doing that? If there's a jobs number today and another one in another week, and there's an unemployment rating in between, I mean, sure, we need to maybe manage the risk around that. But ultimately, in the long run, the market will just look right through that, right? And so I guess that's a long way of saying, Eric, that the stock market really is not the economy. For almost 2.5 years now, we've been going through this debate of, are we going into a recession? Are we already in a recession? And if we're not in a recession, is it going to be a hard landing or a soft landing? And these are good questions to ask, but all the while, maybe except for a few weeks that we've seen going into or surrounded by the first quarter of 2025, the market's basically gone up in a straight line. And that's because, again, the market is made up of a handful of companies. And if you think about the Magnificent Seven or some of the largest structural growth companies that are out there, their earnings are often insulated from these day-to-day macro data points and from all of the noise, as you say, that's out there. So I think what investors should remember in a time like this is to step back and look at the bigger picture, understand what's actually driving the earnings of some of the biggest companies that are out there. And oftentimes that's a better read for how things will play out moving forward than simply trading every day-to-day piece of news or headline that's out there.
Okay, all right. And so speaking on risk management and the first quarter of 2025, we saw a ton of volatility in the market. So I was hoping you could shed a light on what strategies you guys do to deal with that volatility and your perspective on if you see this volatility persisting throughout the rest of the year.
Yeah, those are really good questions. I think, look, let's take the first one, or take a crack at the first one. I think when we came into this year, we'll put our hands up, and a lot of people probably shared the same view that Trump 2.0, in terms of the second presidency of Donald Trump, would actually be very positive for corporate America. So when even many were talking about how overvalued the US was, we could debate that. But again, we were actually looking at Trump 2.0 as positive for a broadening out of the US rally. Obviously, 2023 and even parts of 2024, it was more about what we call the Magnificent Seven, or a concentrated portion of the market that was leading the rally. We actually thought that if Trump 2.0 could come in the way that we thought it would, and specifically around things like tax cut extensions or M&A activity that should increase, right, in a lower rate environment, given how Trump's administration has often positioned how they expect to see their administration playing out. M&A activity was obviously a big part of that agenda. And then furthermore, you think about deregulation, right? Scott Bessent, this Treasury Secretary, has often talked a lot about opening up or unlocking the private sector, which is a key aspect of allowing capital to move more freely through corporate America and benefiting sectors like industrials and utilities. And then on that note, think about onshoring as another massive tailwind. If you do bring, and again, we did expect tariffs to be somewhat positive for the overall onshoring agenda, because if you do strategically initiate trade negotiations and bring certain trade talks to the table, it can actually bring or allow these companies to strategically and methodically bring their supply chains back to the US or bring them back to Europe. This was already happening before Trump took his second presidency, but we expected this to actually be accelerated. Now, obviously, just about over 100 days into the presidency, things have played out a little bit more difficultly. And so what we ended up seeing was a big blackboard with tariffs and countries on them, and that doesn't give any of these companies that are impacted a fighting chance of executing on this reshoring or this onshoring initiative. So I think when that happened, the market started to quickly price in a lot of the bad news and put things like the positive catalysts, like deregulation, like tax cuts, like M&A activity that will still probably happen, but put that on the back burner and said, okay, well, how do we model out this obviously this volatility created by tariffs and sort of the chaotic approach that's been taken to put those tariffs out there. I think for us, what we immediately realized was it was clear that the market was trading at a multiple that was unsustainable given the level of tariffs that have been put out there. So we did a few things that I think are ingrained in our 19-year philosophy and have been key parts of allowing us to maintain our sort of medium risk rating, if you will, across all of our strategies, despite being growth investors. So first and foremost, we realized that we do have a proprietary stop loss process that's on an individual stock basis. A lot of our portfolio holdings, as you can imagine, did experience a 20% or greater drawdown. But for us, in that process, any stock that does fall 20% from its peak or cost, it's subject to an automatic review. And at this review, ultimately, every single portfolio manager that is responsible for a position must go back to review the facts. So they take a look at the actual model that they've built. First and foremost, understand if there is a material impact. Going back to my last point about was there an actual material impact to the earnings of this company? Have we ultimately mismodeled something? Are we too optimistic about a certain aspect of that investment thesis? Even if he or she believes that the stock continues to deserve a place in the portfolio, they must go and defend that position to the entire investment team. And now there's no mechanical way in which that a stock is dealt with, but ultimately this objective review function, we think, allows for us to remove some of the emotional biases associated. And through this process, we've actually removed areas that in this, in hindsight might seem obvious, but it's harder to do when you have positions that have strong medium-term outlooks, but ultimately anything to do with the end consumer, for example, right? Names like Shark Ninja, names like On Running, which are great businesses, but ultimately would clearly struggle in a high tariff environment. Other areas like semiconductors, for example, which again, we're massive proponents of the semiconductor opportunity. We think that not just NVIDIA, but a handful of semiconductor companies are going to be crucial parts of this artificial intelligence trade, or again, the artificial intelligence boom that we're seeing. But again, short term, in a world of high tariffs with export controls and other forms of economic weakness around the world from China and other places, well, obviously semiconductors don't look as attractive to us. So we did stop out of some of those names. And then finally, in a slower growth environment, if earning revisions are meant to happen, and what I mean by that, if companies' profit outlooks start to deteriorate, well, it's the companies with the highest valuations or the highest multiples, as we call them, along with the smaller cap companies in nature that are going to get hit the hardest, that are going to have the hardest time defending those valuations. So across those three areas, we took profits, we stepped to the sidelines on many names. And ultimately what we did with that cash, especially in our fully invested mandates, our long only funds, if you will, we put that money back to work in what we call high quality growth. And so these are companies that have strong balance sheets, lots of cash, continue to generate a lot of cash, and I think most importantly, act as industry leaders, have the most market share in their respective industries, have a lot of pricing power that they can pass on to their customers if in terms of passing on their higher input costs to customers if they need to. These were sort of the types of names that we added to, and that looks like, digital businesses, for example, like Netflix or Spotify, right? I mean, you might cancel your fancy vacation to Europe or somewhere nice if you're feeling a pinch in your pocket as a consumer, but you probably, in terms of your Netflix subscription, that's probably the last to go. So it's digital businesses like that we retain conviction on. We've added to names in healthcare that often have resilient business models, and we've seen that through the latest reporting season. And then finally, some of these security and defense businesses backed by structural trends. We've seen obviously Europe take a very positive tone towards adding to their defense budgets or spending more money on national defense. The US is obviously working on a massive package, and we think more countries will come out with these types of things. So those are a few, that's a little bit of insight into where we deployed that cash. And then I guess to round this out, Eric, obviously, as you know, we run a liquid alternative strategy, a long short fund, if you will.
And that's the most commonly fund that we use for our clients, the long short fund, based on the risk characteristics. So you could explain a bit more about that strategy too.
Yeah, exactly. So if you take everything I just described already as what we did throughout all of our funds in the liquid alternative, we can go one step further and say, well, we don't need to be always fully invested in this. So what did we do on top of the stop losses, on top of high grading the portfolio to more quality names? We also use things like short dated put options. So these are basically like little insurance contracts that we can layer onto the market that'll add value if the market was to fall below a certain level. We can do things like short equities, or specifically short futures contracts or on the broader stock market, which will again supplement those put options, add value, and take an inverse bet on the market if the market was to fall. And then, of course, I think the greatest hedge that you can have in general is to have higher levels of cash in an uncertain period. So we pulled all of these levers to varying degrees, and we brought the long short fund in particular to a much lower exposure going into what we now know as Liberation Day. And obviously we've retreated back to some of those levels, but in that uncertain period, if you think just before April 9th, when the market was at its lows, the long short fund did meaningfully protect versus other equity allocations that you might have seen out there. So hopefully that gives you a sense of what we've done through this recent volatility. I guess the second part of your question was, do we expect it to persist? I think the answer, if I had to sort of give you a yes or no answer, is that yes, we do expect this volatility to persist. It's not always bad volatility, right? Volatility works in both directions, but I think the reason we're not quite there yet in terms of saying all of this volatility is behind us is simply because of how quickly we've seen these headlines be traded. Going back to what we talked about earlier, all of the noise that's been traded in markets. Unfortunately, what that means is, the market started by pricing in all of this bad news, brought the equity markets to much lower levels, but then immediately start to price in some of the positive headlines that we've seen around trade deals and obviously around strong earnings season that we've just seen in terms of companies reporting. So it's quick. It's easy to see that the market is ready to price in incremental news, whether it's good or bad, almost immediately, and that can often create bouts of volatility. And so, yes, we've seen obviously even today positive news around the U.S. and China negotiations, for example, that's sent markets incrementally higher. But what happens if all of the dust settles and some of the trade deals that are done, that are actually signed and ready to go, are still materially worse than where we were before tariffs became announced in the first place? So it's for that reason that we're still not fully back invested in a more bullish manner, let's call it, in our long short fund. We have put some cash back to work since where we were in mid-April, but at the same time, I think that because of increased levels of volatility that can continue to persist, we're still just being, let's call it, cautiously optimistic here.
Okay, that's interesting. So, my job as an advisor, we have to understand our clients' goals and objectives, their risk tolerance, any behavioral and emotional biases that they may have towards investing. And we find you guys really helpful at Munro Partners because you have an offering that can be suitable to different groups, right? So for our more conservative, older clients who still need growth, we'll use something like the long short strategy. And then maybe for our younger clients that have a significantly longer time horizon and have the capacity to handle more risk, we'll use the long strategy. But within both those strategies, as we talked about today, it's all focused on structural growth. So could you just to summarize everything, explain why investors need to have structural growth companies in their portfolio, even if it's a small chunk or a large portion of their portfolio? Why is it so important? Just to recap everything that you went through today.
Yeah, it's a really good question, and obviously, as a structural growth investor, we're obviously going to always have a positive view on structural growth. But to maybe as objectively as possible answer that question, over the long run, look, it's a handful of companies that drive the returns in the market, right? I think that's data driven. That's not just a Munro view. If you look at extended periods of returns in any index or any market around the world, it's often a handful of winners and lots of losers. And if you dive into or peel away layers of that concentrated portion of very few winners, you'll often find that they are benefiting from some form of secular tailwind or structural trend that's occurring in the world. There are many in our portfolio that we're excited about. To name a few, think about the decarbonization of the planet. That's a $50 trillion opportunity, we think, from a revenue and earnings growth standpoint. We've done really well by investing in companies there that are now tied to, of course, the artificial intelligence boom, which is in its own right one of the biggest shifts that's happening in the world, both through digital businesses that are bringing AI applications to light, as well as the enablers, the semiconductor companies, the infrastructure companies, even some of the climate change companies that need to enable data centers from an HVAC or an insulation perspective. Think about the security and defense trends that are playing out around us, or innovations in healthcare. These are the things that ultimately drive the biggest earnings growth potential for companies in the market, and therefore drive a lot of the value in the market over long periods of time. So over a long term, you want to be investing in these massive structural trends and the handful of winners, because that's ultimately what shapes markets over a long period of time. And the data will prove that. Now, on a short-term basis, or maybe on a short to medium-term basis, here's why you need structural growth, okay? Because when we came into the year, even structural growth investors like ourselves looked at some of these companies and said, there's a lot of money piling into these names, right? Names that were unsure, or money that was on the sidelines through 2022 and going into 2023 that finally started to add significantly to your Nvidias and some of these other names that caught a lot of momentum through the back end of 2024. So if you think very simplistically as of a stock or a set of stocks as over-owned or under-owned versus overvalued and undervalued, you unfortunately did check that box of over-owned for some of these structural growth names coming into this year, right? On top of that, many of them were perhaps not overvalued, but reaching points where you could say that their valuations were trading at the top of the range. So again, it's very hard to feel optimistic about any asset class that has that setup, over-owned and also potentially overvalued. A lot of that has flipped on both fronts now, right? So you look at some of these names, a lot of the positioning or the owners of these names have washed out their positioning. They're a lot less owned than they were coming into this year. On top of that, you see on the other side that many of these names, let's just use them. I'm not saying that we only invest in the Magnificent Seven. In fact, we only like a handful of them here today. But even just looking at that cohort of the market, coming into the year trading at 28 or 29 times forward earnings on average, now they're at a much more digestible level, trading in and around, or even in many cases below their historical average valuations. So if you think about structural growth as now no longer over-owned, probably under-owned, and potentially overvalued or undervalued, I should say, or potentially at the highest level fairly valued, that's an interesting setup going forward for any asset class. Now let's look at the path ahead. Let's say a whole bunch of trade deals are done, right? Let's say that all of this tariff stuff ends up being behind us and the market is forward looking. Earnings growth is solid. The economy doesn't collapse. Donald Trump's now friends with everybody all over again. That's an environment where you want to be in companies that have the highest level of earnings growth, because once the market goes back from or moves away from trading every day these macro and geopolitical headlines, eventually it'll go back and say, well, where are the most attractive earnings growth stories or the strongest fundamentals trading at acceptable or potentially undervalued valuations? We think that today, again, is structural growth, similar to how we were looking at things in 2022. Let's take the other route, right? Let's say that these trade deals blow up and we ultimately don't make any progress, or the progress that's made from a geopolitical standpoint is nowhere near enough what the market was hoping for, right? In other words, we end up in a much worse place than we were before we came into what's now known as Liberation Day. Even then, where do you really want to be? If you're a big institutional allocator that needs to be invested somewhere, well, you're going to invest in companies that have the best chance of surviving any economic weakness that's brought on from tariffs, right? You want to invest in companies that are very hard to tariff in the first place, like a Netflix or a Spotify. You want to invest in companies that own their industry, or at least have the biggest market share in that industry, so that they have what's called pricing power to pass on any increase in cost to their end consumer. And then finally, I think you want to invest in companies with the strongest balance sheets that can go back and in a period like today when their stocks are undervalued, go and actually support the shareholder by executing things like share buybacks. And we're seeing all of that already in terms of the market slowly gravitating toward these large cap quality names. So either way, structural growth looks good. In terms of which companies to invest in at any given time, that's where we as fund managers or active managers can make those tactical shifts for you. But as an asset class, I think it's really important to have, to your point, some form of structural growth in the portfolio to play whichever scenario that I just described becomes a reality from here.
Understood. That's a great summary that's going to really resonate with a lot of people. So that's it for the time we had today. Appreciate you coming out, having a chat with us, and sharing your knowledge and your insights about what's happening. Our team is a proud supporter of your strategy and will continue to be so. So all the best to you guys in the year ahead. And once again, thanks for your time.
Awesome. Thanks a lot, Eric. And looking forward to catching up again sometime.
Okay, take care. Bye for now.